Hi everybody, welcome to Facebook Live. I am Tina Powell, Head of Strategic Initiatives for Beacon Wealth Management. Today we have really an exciting program. I'm thrilled that we're going to be speaking with Mark Germain, who's the CEO and founder of Beacon Wealth Management. But before I do, you guys know the drill. I have to read just a little statement, legal statement here, so bear with me for just a second. It'll take me 10-15 seconds. Today is Wednesday, August 23rd, 2017, and the time is 3 p.m. Eastern Standard Time. This Facebook Live is being recorded, so please remember that this broadcast is giving an opinion and not blanket advice. Any performance numbers are historic. You must put your personal situation in perspective and speak to an investment professional, ideally someone that knows you personally and understands your goals and objectives. Thank you. So today I'm going to interview Mark Germain, who is the CEO and founder of Beacon Wealth Management, and we're going to talk about why you got started in wealth management and what Beacon Wealth Management is, and give us a little bit of backstory. And then I also have some questions prepared about what does a beginner investor do, and what about families that have college-age children. And then finally, of course, we want to get your perspective on the market. And so with that, let me just say thanks very much for making the time.
Alrighty. Well, I'm excited. Welcome everyone to Facebook Live.
So now, of course, I know that Beacon Wealth Management just celebrated our 15th anniversary. Congratulations.
Thank you.
So I was hoping maybe you could provide a little bit of backstory. How did you get started in wealth management, and how and why did you create Beacon Wealth Management?
Well, Beacon Wealth, as you said, has been 15 years. But really, it started 33 years ago, because I started in the wealth management and financial services business 15 years ago after a stint with the Big 8 accounting firm of Touche Ross. And what I found was people were great about developing ideas, but not very good at implementing. So Beacon was really formed to get things done. Mm-hmm. And that's what Beacon Wealth is. It's a company that deals with the financial decision points in people's lives, and we get things done for them.
So how does one define wealth management? We hear a lot of different terms being thrown out, wealth management and financial planning. So what's the big differentiator between wealth management and financial planning?
Well, I think oftentimes they're used synonymously, that financial planning and wealth management kind of go together.
Right.
But wealth management is looking at everything from start to finish and really making sure that you're looking at every aspect of what is going on. Financial planning means creating a plan for a specific point in time. Wealth management is ongoing and dynamic. And it's a major part of our business that when we work with our clients, we spend an awful lot of time with new topics. It's not something that they thought about 5 years ago when they became a client. All of a sudden, it's a new topic. So it isn't something that could have been covered in the financial plan.
Interesting. So if one thinks that they're in need of wealth management service, and if I'm hearing you correctly, also includes financial planning, how does one get here? Do you just show up at this beautiful office here in Hackensack, New Jersey, and knock on the door and say, I'm here to discuss wealth management? How does the process work?
We've really never had a line of people out the door like Smashburger does or anything else. We don't have the people lined up at the door, unfortunately. And also, if you were to walk in, there's 2 lead advisors and half a dozen paraplanners and client service people. They're already working on client projects. So everyone is busy all day. So if you just walked in, you might not be able to get a question answered on what you want to have answered, and you wouldn't be able to sit down. So what we do is we say, give us a call. We'll set a time to go through what is it that you want to talk about, what are you trying to solve for, and let's determine what the action steps might be, and then we will set you up a time so you can sit in our beautiful office and we can answer the questions for you as to what is the next step in your wealth management process.
And how many advisors are typically in a firm? I know that here that you're not the only lead advisor. Can you discuss some of the differences between the main advisors that are here and perhaps some of the specialties and the types of clients that they serve?
Sure.
You serve?
I think it's important to say that a wealth management firm doesn't have a set number of advisors.
Okay.
The wealth management firm and the size of the wealth management firm and how many advisors is going to be dictated by the number of clients and the number of things that you're doing for all of those clients. So in our practice, we have 2 lead advisors, but we have 3 separate silos of people that we serve. And those 3 silos have 3 people on each team that are working with the clients. So that it's a team approach. So no client comes through the door that they're not able to always, if they can't get the lead advisor on a particular day because he's dealing on another set of client issues, he's going to be able to deal with the paraplanner or the client service person. He's going to be able to deal with someone. We are a firm that, although we are totally technologically advanced and paperless, that we insist on talking to people and not utilizing email as our source of communication. So when we look at how we've split up the advisors, obviously I am no longer in the millennial or the Gen X class. So what we have done is we've said that we have clients that are boomers and Gen Xers who have built their wealth, and their most important concern is, I don't want to have to rebuild the wealth. I want to keep what I have, and I want to add to it. And then there is the millennial. And the millennial is saying, well, I'm at the beginning of my investing process. I'm at the beginning of the planning process. So we have a millennial lead advisor.
Right.
And we have a boomer lead advisor.
And that seems to make a lot of sense because with wealth management and with financial planning, you're dealing not only with financial issues, but more importantly, you're dealing with life issues and life events. So ideally, it's good to have an advisor that is in your peer group that really understands what you're going through. Was it designed like that?
I think that it was designed that way out of necessity. So it may not have been such a thoughtful process that the advisor has to have an empathy and work and plan and have similar things going on in their life, but it happened. So obviously, if I've been doing this for 33 years, I went through the millennial stage, I went through the Gen X stage, and then grudgingly they pulled me into the boomer stage. And so as we get there, it's that wealth of experience at each of the levels that now as we deal with a boomer client and we start to say, what about the children and what about the next generation? A, there is an empathy because I've gone through that process, and B, we now have a millennial advisor, lead advisor, as well as the assistant advisors are all millennials, so that they're all able to track and create a legacy component as the firm goes forward. That clients aren't going to worry that, oh, something's going to happen to my boomer advisor and I'm not going to have anyone to take care of things. Hence, we have the team approach, we have the millennial approach, and we have millennials on each team.
So what are the types of issues? What are the types of client issues? You mentioned a very important part, and that is that there's the baby boomers, and then there's the millennials, and there's people like me, the Gen Xers now, and we all fall into these certain categories. So what are you seeing across, what type of planning issues are you seeing across each of those 3 different generations?
I think it's really important to define that wealth management deals with financial decision points. And every day, people have a financial decision point, whether they're going to buy a maca latte whatever they're going to buy.
Frappuccino, skinny soy.
half calf, half decaf, or they're just going to buy Dunkin' Donuts coffee.
Yeah.
All right? So they're going to make a financial decision every single day. But the things that we're concerned with is not whether it's a double shot or a single shot. We're concerned with the financial decision points with education, with funding their mortgage, with building their retirement, making sure that the dollars come out. Oh, I need cash flow off of my account. I have 4 kids and they all have to go to camp, and then I have college tuitions in the fall. So these are major decision points that go on all the time. I want to leave to my children. My spouse is sick, and I want to have something to make sure that happens. Someone in my family is sick or has passed away. How do we handle that? So the financial decision points are not necessarily what people are thinking about every single day, but they're what they come through the office to talk about, or they call on the phone. As simple a thing as, do I buy a car or lease a car? And we will have the answer quicker than if they have to sit down and do their own tables.
Because it's the simple decisions. That's what the simplest of decisions can have the biggest results.
Yes, that's a good point. But financial planning in wealth management, and particularly wealth management, really deals with cash flow management. So whether you're a millennial or you're a boomer, it's about cash flow management. At the beginning of the line, it's, I have this much money coming in, I want to make sure I pay all of these things, and I would like to find a way to save some money. Hopefully when you get to the boomer stage, is I have all of this money, I don't want it to all be taxed, so the tax becomes a major component. The cash flow is a major component. And where do I invest, how do I invest, and how do I make sure that I keep as much as possible? Because it's really about what you keep, not how much you make. It's really
and
about
that's
how much you
affected
keep.
again by your spending, by the simple decision that we talked about, and also too where you're putting that money, because things are taxed. Different accounts are taxed differently,
and
so that's
investments are taxed
exactly.
differently.
So the recommendations are very strategic, and helping that particular client achieve what it is that they want to achieve.
Yep.
So then,
Absolutely.
what about? I know that friends on Facebook and people that I know outside of the firm, they would love to be able to be a client of Beacon Wealth Management and other financial firms. They'd love to have the assets. And one of the things that I learned investing, but it wasn't until later on. What happens? Where does one start right now? What advice do you have for the beginner investor? Look, somebody that's maybe 20 or 30 years old, and maybe 20 years from now says, you know what? I want to walk into this office and I want to sit down and have you strategize a cash flow strategy for me and help me keep more of what I'm making, so that this way I can share it with my family. And
one of the richest people in the world and one of the best known investors in the world is Warren Buffett. And Warren Buffett will tell you that there's nothing more powerful than compound earnings. And compound earnings is nothing more than earning on what you earn on your investment. So if you invest $1,000 and it makes 5%, next year, you're getting interest on $1,050. And now the amount of interest that you get on that account is now higher. That's the process of compounding.
Because that base is growing.
Correct.
Right, the
base
interest
is growing.
rate, exactly.
The base is growing.
Mm-hmm.
You now you're also earning interest on the interest, or earnings on the earnings, however you want to say it. But the most important thing, and your question was, what's the most important thing? How do you get started? It's very easy to get started. You can save in the workplace today. Almost every company has a 401k plan, 403b if you happen to be in public service, and you can start right at work, coming right out of your paycheck. I will tell you that when you start to invest, and when you want to start to invest, the most important thing is consistency and to always save. So I would always tell people, if you save 10% of what you make, you will retire wealthy. Not comfortable, wealthy.
Save 10% of what you make, put it in a retirement vehicle, such as a 401k, 403b, just save it.
And
put
then
it there.
eventually 10% is going to be more than you can put into a 401k vehicle.
Right.
And so...
Is that 401k the first place where, or the 401k or the 403b?
We think it's one of the first places to start saving.
Okay.
Or investing. Your question was on investing.
Investing.
It's one of the first places to start investing because it's also tax deductible. So for a millennial, the first $18,000 that they put into a 401k comes right off and isn't taxed. So the federal government is helping you save that money.
It's a pretty good incentive.
It's a great incentive. So consistency. So you can save automatically at work. The next thing is to make it automatic, come right out of your checking account, go right to your investment account. You can open an investment account online instantly with every one of the major firms, with Schwab and TD and Fidelity, all of the major firms. You can open them right online instantaneously, and you can start saving as little as $100.
And then what about picking the investment vehicles within that account? And I think that that's where a lot of people get tripped up because there are thousands upon thousands of different types of investments, stocks, bonds, exchange traded funds, mutual funds. So how does the beginner get started when the investment landscape is so daunting?
Well, I think the number one thing to remember is don't rely on the media to tell you where to invest. Rely on what is your objective. Is your objective that you're going to put the money away and it's going to grow for a long period of time? There is no single better investment for the long term than stocks. It's not cash, it's not a savings account, it's not an annuity, it's not any specific quote-unquote product, but it is the equity or the stock market. It has outperformed the bond market. However, it is also higher on the risk scale. So the concept is, how long are you willing to invest for? If it's short-term investing, you don't want to make a bet on the stock market.
And define short-term.
Short-term is a year to 2 years.
Okay.
If you don't have a couple of years, you shouldn't be investing in the stock market per se, unless you're going to go and do the research and become your own stock picker and become a trader. Not recommended. Recommendation for someone starting out. How risky are you? Well, I'm half as risky as the market. Okay, so you can buy half in the equity market, half in the bond market. How simple is that to do? You can go and buy the S&P 500, all 500 stocks, with one purchase for free at any one of the major exchanges. At any one, TD Ameritrade, they'll give you a free first number of trades. You could buy an ETF, which invests in the S&P 500 exchange traded fund.
And that would give you a broad basket, obviously.
Gives you 500 different stocks.
Basket bigger than, right.
It gives you
so
500.
So that you could get it, instead of having to make like 500 individual trades,
Correct.
let me think about the type of stock that I want to buy. So you're saying just, look, buy an entire index, buy an entire pool.
So you can buy 50% in the S&P 500, and you can buy 50% in the broad-based bond market, all at the same time, 50% here, 50% here, done. And that would be your first investment, and you would be diversified both on the bond side and the stock side. You can look for high-quality mutual funds that are out there that will manage and go in and out of different stocks. To start off with, ETFs, very low cost, easy in, easy out, tax efficient, which is very important for people starting out. And that's one of the easy ways to do it. We have exchange traded funds in every one of our client portfolios. Why? Because they're inexpensive and they're tax efficient, and we can be very specific as to what areas of the market we're investing in.
It's good information. Thank you for that. And so how many clients are here? There's over easily over
well over
160. Right,
well over
so 160. So where do you see clients getting it right, and where do you see the most, I'd say, like, what is the most common thing or common area of focus right now for clients or for new clients coming in?
Not 100% sure of your question when you say the most common area of focus. The biggest concern as they walk through the door?
So I mean, clients have to be doing a lot of things right to begin with. The fact that they come here and say, I would like my assets managed and help me make good financial decision making and help me with my cash flow, maybe estate planning and tax planning on top of that. But what I'm asking for is, I guess, a deeper question too, and that what is it that seems to be, I don't want to say people getting it wrong, but where are people needing the most help? Like, what is the common denominator that you are seeing from new client after new client that almost looks like it's a trend, or I guess a repeatable?
Let's split it into two topics. Let's split it into what we'll call the wealth management topic, and let's split it into what we call the investment topic, right? Because although they're combined, investment management is different than the wealth management side. The biggest mistake in investment management is new investors think that they can predict what's going to happen to the market. Or they go to an advisor and the advisor says, I can predict what the market has. I would run in the opposite direction if someone says to you, I can predict what's going to happen in the market. No one can.
Market timing.
Yeah, impossible to do. You cannot do it effectively for other than a couple of lucky opportunities. So no, you can't time the market. So that's the biggest mistake in investment management, is they say, well, the market went up today, so I'm going to wait and I'm going to buy it when it goes down. The average amateur investor will never buy into the market when it goes down, which is the best time to buy it. So we sit with cash in client accounts, and they'll call and say, why are we sitting in cash? We're waiting for the market to go down. So when the market went down last week, we bought. And that's the key, is they tend to make their decisions with their heart instead of with their head.
So that's on the
investment side. On
So
the wealth management side, it's failing to be consistent and failing to start. So you asked the question a few questions ago, what's the first thing they should do? How do they get started? And the most important thing in anything to do with wealth management is get started. There is no simple answer, everything's going to turn out okay, I just have to have this designed and then I'm going to be okay. Start with one thing.
And it sounds like, too, it's more of the behavior. It's a form of behavior modification. Let me start with one thing, and you had mentioned the word automatic. Just make savings automatic, and yes, taking that and putting it in an investment account, but just being consistent over time with that 10% that you talked about.
One of the biggest areas that people come in that they're ill prepared for is financing their children's education.
Education is a big nut to crack. I mean, look, a nice prestigious university is going to now run you, what, $70,000 a year?
$70,000 a year.
$70,000 a year.
Education is rising faster than any other component of the economy. So it continues to rise at plus 5% per year, even when inflation is 2%.
The universities have built-in accelerators, right?
They have built-in accelerators.
Okay.
Now, the biggest problem is people don't plan for that. And it begins to frighten them, so they do nothing. Something is better than nothing. So starting, and where do we start? We don't start an account for one of our children that they're going to be able to take out at age 18 and make the decision, you saved $60,000. I think I'd rather have a used Porsche than go to Princeton. They don't get to make that decision in a 529 plan. 529 plan is tax sheltered, will never have tax on the earnings if you use it for education, and the parents or the people who form it, the people that open it, always have a string on it that they can change the beneficiary.
So what if I haven't had the luxury of time that I, as a family, let's say that my daughter's ready to start college coming up in the fall, and I haven't yet done anything about it. What advice do you have for that person with looking at those daunting education costs?
I would say get to a professional advisor.
Okay.
Okay. And once you get to that professional advisor, be prepared that you're going to have to figure out, how do I use some of the assets that I have, whether it's taking a loan from your 401k plan, borrowing against your home, doing student loans, any variety, any combination. The schools are going to work with you to help you on that. But what becomes important from the wealth management side on our part is, where's the most tax efficient manner in order to do that? If you're a business person, there's a number of different ways that you can do it to make it very, very beneficial. But the most important thing is to get in with somebody and start planning it, whether it's your CPA, whether it's a financial advisor, but someone who actually knows how to do that planning. And if you're going to go to a wealth management firm or a financial advisory firm, ask them what experience they have doing it, what is their typical recommendation, before you make a decision that that's where you're going to put your money.
It sounds like we could have an entire segment just on the college planning, and then
we could spend a week on
refinance.
college planning.
Good. Okay. Well, thanks. Before we head out, what would be your last recommendations for everyone listening here on Facebook Live tonight? Give us some parting thoughts.
Well, I think it's really important that everyone realize that almost the entire population makes mistakes in the wealth management and the investment side. Do not punish yourself for a mistake because you didn't start early enough. You made a bad investment. That's okay.
That's life. That's normal.
Life. It's normal.
Right.
And the most important thing is to get started and be consistent. And there is no one answer. We tell people all the time, we don't know if this is the answer. It is an answer that works. So realize that you can find an answer, and the most important thing is to get started.
Well, thank you. We appreciate your time. And if any of our Facebook Live audience have any questions, what's the best way to get in contact with you? Obviously, too, you can send it through Facebook Messenger. We'll get the question as well.
Facebook Messenger will do it. Much quicker and easier is to send it to the person we call head of first impressions. Is to send it to Lynette, LINETTE at bwmllc.com. And any of the Facebook listeners, if you have a question, you want direction, you want a kind of a guiding light, we'll call it a beacon. So
that's great. I like that.
You want a guiding light or a beacon? Send to Lynette at bwmllc.com your question. We will respond to your question with an answer. And if it's something that you need to talk to someone, we will alert you to that and point you in the right direction if it's us or it's someone else.
Well, thank you, Mark. This was extremely helpful. I wanted to close by just saying, everybody, thanks on Facebook Live.
We're supposed to wave now?
Send us, you can do the Facebook Live wave here. Ready? Okay, thanks, everybody. Have a good day.